Hello, I'm Joshua Carr. Today I'm going to talk to you about how to build a financial model for the analysis of a real estate investment. In this series, I'm going to build a relatively complex financial model piece by piece, and you can watch me do it. I'll start with something really simple, and over time, I'll just keep upping the complexity. In addition, I'd like to say that if you have any questions about the direction of this model, if there's something specific that you'd like me to build, or you just feel like sharing, please let me know in the comments section below or email me at josh@kahrrealestate.com. Again, that's Josh, Josh, at kahrrealestate.com. Great. So with that, I'm going to start by building a very simple model, and we'll just, again, up the complexity. And hopefully over, a series of videos, we can get into some interesting things. So first, I want to have a few sheets. I'm going to build a few worksheets here so the right things can go in the right places. And again, I don't really have a grand overarching strategy for this, but I do want to sort of, have some framework that makes sense. So I usually have an executive summary page. The point of an executive summary page is, of course, to have, well, things where you're summarizing results so people can see what you're doing, and I'll spend some time formatting it. I'll have an assumptions page because we need some inputs. I'll have a cash flow where the assumptions will build things. And over time, I'm going to do some subsheets, other detailed sheets to build up to the cash flow, but for now, we'll have a cash flow page. I'll have a valuation page, valuation at sale, because if you buy it, you need to sell it. And finally, I'm going to have sheet 5 will be a return analysis. And this is somewhere where I can take the cash flow, take the valuation at sale, pull it all together, and hopefully have some results that make sense, and can go to the summary page. We're not going to put everything on one worksheet. It wouldn't make a lot of sense to put everything on one worksheet because that would be, well, frankly, incredibly messy, and we'll talk more about that. So for assumptions, let's start with some simple assumptions. I'm going to have a size of the asset, say a square footage, and I'll say it's 10,000 feet. I'm going to say that we have a rent, which I'll express as dollars per square foot. And yeah, this is going to get a lot worse. And I'll make that, say, 20 bucks. And I'm going to have operating expenses. And again, we'll build that out quite a bit. But for now, I'll just say operating expenses of, say, $10 per foot. We're going to have a general vacancy rate. Later, we'll talk about vacancy versus credit loss and all kinds of good things like that. I'll make that 10%. I'm going to need a purchase price. I'll come back to that. Yeah, I'll make it, I don't know, $1 million. Fine. I'm going to need a cap rate because eventually we're going to sell something for something. Maybe I'll make that 8%. So how do we capitalize the long-term value of the investment? And then we need some growth rate for the income and growth rate for the expenses. And for those of you who built much worse models, I realize this is kind of trivial and simple, but again, we got to start with the basics. Basics, walk before you can run and all that sort of stuff. Cool. So we have some simple assumptions, which again is not really that complex. And just for kicks, I'll call this my assumptions page. Not that I need to, but yeah, one extra S. Cool. Okay, so now we've got a cash flow page. Again, just boldface that. And I'm going to have gross potential revenue. I'm going to have general vacancy. That's going to get me to my effective gross revenue. We're going to have some operating expenses, and we're going to have net operating income. Cool. And because we need some years, I'm just going to put in like 1, 2, 3, 4, 5. I could do more years than that, but 5 years is perfectly fine. Let me just adjust this and zoom in a little bit. Cool. So formulas. NOI is going to be EGR minus OPEX, and I'll bring that across. That's just me pressing Control R to copy to the right, or I could have done a drag copy, but that's fine. The general potential revenue to start with will be the square footage times the rent. The EGR will be, of course, potential revenue, add the negative vacancy rate. OpEx will be 10,000 feet times 10. In this case, I'll show that as 100,000. It's being shown as a positive value. Generally, things that are expected are positive, like you expect expenses to cost you money, so that's positive. By comparison, vacancy, a loss on the revenue side, is usually shown as negative. So this, I'll take the $200,000 and I'll multiply that by negative 10%, and there it is, negative 20. Awesome. And then I will take this and I need to bring it across. Now, before I do, a couple things to do. First off, the general vacancy is going to be the same in all 5 years. It's always 10% of the year above it. But we don't want the vacancy rate to move. We want the line 6 to move. We don't want assumptions D11 to move. So I'll throw some dollar signs on that by pressing F4, and I'll bring that little baby across. Cool. Then for EGR, I can also drag that across. For potential gross revenue or gross potential revenue, usually I do potential gross revenue, PGR. That would be year 1 times 1 plus the rate of growth. And there it is. And then if I'm going to drag that across, I float the D6, whereas I fix the D17. Again, by throwing in some dollar signs, I pressed F4. That's on a Windows machine. I think on a Mac it's Command T or Control T. Honestly, I don't know. I don't use Macs because Macs are for artists and children. Let me drag this across. And yeah, I know that was an unfair ding on Macintosh users. I'm sorry. I can be a little bit of an SOB about that. But, you know, c'est la vie. Okay, great. So let me bring that back. OpEx is the 100,000 times 1 plus the expense rate of growth, dollar signs, close parentheses. Bring that across too. And there you go. We've got some stream of revenue. Okay, good stuff. Now to value this, if I'm going to sell it at the end of year 5, I'm usually still going to need year 6 as revenue. So even though I said we're only going to hold it for 5 years, I'm going to add on a 6th year. I'll talk more about this later, but generally, if you're selling at the end of year 5, you're going to use year 6 to figure out the sale price. The same way if you were buying it today, you'd use year 1's NOI to generate your purchase price today. And yeah, this is a lot more complex. This can get a lot more complex, but again, we're starting with the basics. So the valuation will be, again, making this a little bit bigger, and I'll call this valuation at sale. And I could say this is NOI year 6, and this is a cap rate. The cap rate in this case was, again, 8%. The NOI in year 6 was 98 grand. I take the 98, I divide it by the 8%. Let me format that so it's all nice and clean. There it is. We're valuing it at $1.2 million. And yes, I haven't put in anything about like brokerage fees, closing costs, the rest of that. We'll deal with that later. And now for return analysis, and you know, you may wonder again why I'm putting this on so many sheets. It's because if you're planning as I am to make this really deep and thick, you need to sort of build out multiple sheets so it'll be nice and clean. In any event, let me lay this baby out here. So if we're saying year 0 to year 5, year 0 being when you bought it, we've got the purchase, we've got cash flow, and we'll call that cash flow from operations, and I'll call this cash flow sale. And again, it'll get worse, don't worry. The purchase price would be $1 million. The cash flow from operations otherwise known as the NOI, is 80, dragging my way across. At sale, year 5 and sale happen at the same time. So the sale and the operations will just have both in year 5. Later, when I do monthly cash flows, we can play with it. I'll make that the sale price right there. I'll format that nice and clean. And for kicks, I'll put an internal rate of return. And I'll just do a simple IRR. Actually, wait, sorry. We need to sum that little guy up there. So I'll sum it. Put a line in there just to make it pretty. Drag that across. IRR is 12%. There it is. So in short, we've got some basic assumptions. Make that a bit bigger so everyone can see it. Maybe do a little formatting there just so it's nice and clean looking. A little formatting, never hurt anyone. Cash flow, I've got a cash flow statement year 1 to 6. Again, we're only holding it for 5 years. I'll talk more about this later. We've got a valuation at sale, not a bad thing. And we've got a return analysis showing that in this case we're making 12%. That's it for video 1. I'll keep doing this in roughly 10 to 15-minute increments, and we will add debt, partnership modeling, and all kinds of ugly and crazy stuff. If you're interested in more content like this, or if you have any suggestions for additional content, again, please contact me at josh@carrealestate.com. My email address is, just so everyone sees it, again, just in case for some reason you don't understand my accent, josh@carrealestate.com. And in addition to that, I also teach a number of live classes. I do Excel modeling training in New York City every few weeks. You can read about that on my website, again, at carrealestate.com. Thanks again, and keep on building better models.